All right, so welcome back to Tech Entrepreneurship. I am doing great this week. Thank you, Maxwell. We're going to be talking about some terms and some subject matter really having to do with valuation. Again, we're continuing along with this path. And I'm going to throw a lot out at you here today. I want to make sure that if you have any questions, you get a chance to respond quickly. And if you have any questions that is outside of the class, if you're looking at this as a recording, feel free to post it on the discussion board or just email me directly. If you post it on the discussion board, everybody has the benefit of looking at the answer also. Okay, any questions or comments? Mr. Maxwell, are we ready to go? All right, so we're going to start off with some terminology. We're going to start off some terminology first. And again, this is valuation continued, right? We've been talking about valuation for a while. So I want to make sure that we understand the distinction between shares authorized, issued, and I also want to make I also want to put in here treasury stock, and we've got a few others. So we had talked, I think it was last week, about shares authorized. Shares authorized is really when you incorporate your business into whatever state or jurisdiction that you're going to be filing in, you're going to have a certain number of shares that are going to be authorized for your corporation. How many shares, if you remember, I don't know if you do, Maxwell, how many shares do I recommend that you start out with if you're going to incorporate? Holy cow, 10 million, right? Oh, you're absolutely right. I appreciate the participation, Maxwell. So 10 million shares. Shares authorized is basically the total number of shares in the business. Now, how is that going to be different than shares issued? How is that going to be different than shares issued? Do you have to give all of the shares? There can be some in reserve not issued, absolutely. So this is going to be the shares in the hands of investors. So what's it called, the shares in reserve? What would the shares in reserve be called, Maxwell? Unissued? How about treasury stock? Yeah, it could be unissued. Treasury stock. These are shares, the delta, the difference of what is authorized and what is issued. Shares not issued, the difference between authorized and issued. Okay, so why is this important? Why am I bringing this up? This seems very elementary, something you could just go online and access. Why is this important? Why would we want to know this in particular? And why is it that you don't issue all of the 10 million shares? So while I'm waiting for Max to type, future increase in working shares affect value for all. That's right. So what Maxwell is talking about is dilution. We'll get into that in a minute. But let's imagine that Roberto and I are business partners. We form a corporation and we go on ahead with my train of thought, which is we now have 10 million shares memorialized with the state of Arizona. We're going to call it NewCo. And we figure that we're going to be 51-49% owners. Roberto's going to be 51%. I'm going to be 49% owner. Typically what I see is the owners use all of the 10 million shares. And this is why it's important, and this is where the rubber meets the road. You don't want to issue all 10 million shares. What I normally see, if there's a 51-49 split, is Robert will have 5,000,001 shares, and I'll have 4,999,999. 4,999,999 shares. Is that right? Anyway, that's what I normally see. I mean, that's using all of the shares. I mean, every single one of them. And when a new partner or new investor comes along, well, then we have to go back to the state, send them a check for $35 or whatever the amount may be in whatever state, and amend the articles of incorporation to add additional shares, which is ridiculous. So why not? Why not say, okay, Robert, you're going to take 6 million. I mean, we're going to issue 6 million shares. We're going to issue 6 million shares. So Robert is going to have 3,000,001 shares, and I'm going to have the 2 million and change. There's our 51-49. Now we have 4 million shares in treasury. 4 million shares in the treasury stock, which essentially are not being used. And then all of a sudden, Robert identifies someone that can program that really fits our company. And that individual may work at Intel, or that individual may work at another company where they're getting stock options. Well, now I can take the 4 million shares and say, oh, okay, hi, Jane, you're going to be part of our company. We can't really pay you that much. We can't pay you what you were getting at Intel, but we can give you some equity. What do you say we give you a certain percentage of our company? And Jane says, well, that's fantastic because I'm really looking for a bigger payday down the road, and I don't need to make what I'm making at Intel for a couple of years. And by that time, we should be generating enough income that maybe we'll be able to make up for that in the salary. Yeah, great, Jane, great. So we're going to give you 1 million shares. Now I still have 3 million shares in treasury stock left. That may be an investor. That may be another employee. Whatever it may be, you don't have to continue to refile and amend your articles of incorporation every time you add an investor or an employee. And Maxwell has a question. Treasury stocks grow with the value if not issued like active ones. Treasury stock is often retired. I don't like to retire the treasury stock. I like to calculate it in the value of the company in total. That way there is no dilution. That way there is no dilution, and we'll get into that a little bit later. Now, we have authorized stock, we have issued, and we have treasury stock. We know that the delta between authorized and issued is treasury. What about the capital structure? We've talked about the capital structure. What is the capital structure of a business? What is the capital structure of your new enterprise? Dividends, well, you're close, Maxwell, you're close. And I'll tell you not quite, but I like how you're thinking. The capital structure is how much equity and debt the business has. How much equity and debt the business has. That's the capital structure. So it's important to recognize, just like you as an individual, how much income do you have? How much debt do you have? With a business, it's a little bit different. How much equity is out there and how much debt do you have? And this plays a significant role in getting additional loans. What's your debt to equity ratio? You can do an acid test on the business to see how much equity is in the business versus how much debt. Now, you don't want too much leverage, and that's what debt is. And in the beginning, I recommend that your capital structure be 100% equity. Why might I recommend that your capital structure not incorporate any SBA loans or any loans from any individuals? Why might I say that you should only have, in the initial stages, 100% equity? Well, primarily because when you open up your own business, if you take a loan out from a bank, they're going to require collateral. They're going to require personal collateral. That collateral may come in the form of your home. And what happens if the business is not successful? Well, there goes your house. What happens, let's take a step back. Let's say that you've got the loan and your business is chugging along. What I've seen in the real world, again, this is real-time, real-world teaching. What I've seen oftentimes in the real world is businesses that are operating their company to pay the debt every month instead of operating their business to grow the business. Banks are going to throw in a number of clauses, I call them sometimes tripwires, where if you are a day late, an hour late, they're going to put you through workout. They're going to start the foreclosure proceedings. And you're really working hard to try to pay the interest payment every month. So you're working to pay the interest off every month instead of working to grow the business. I would prefer that you go to the friends, family, fools, and founders of the business to get money, to grow the business. That way everyone is investing into the business. And if it doesn't quite work out, it's simply a function of you closing the doors. You're not out on the street. You're not lacking a vehicle now. You really have to think this through. And then one of the things that I see out there in the marketplace is I see a lot of banks wanting to make loans to startups. All the time. I'm solicited as ASU faculty fairly regularly by banks that know that I teach entrepreneurship, saying, hey, I'd love to come in and talk to your class about our loan programs, et cetera, et cetera. And the reason why I don't pursue that or I don't encourage it is because I want to see you put in a lot of your own sweat equity, and I don't want to see you tied down and burdened with debt. And chances are you already have a significant amount of debt, or you already have some debt. Levering you up even more to chase your dream could mean failure, and you fail not because of the business anything you did wrong, excuse me, I have to sneeze. Goodness gracious. But you were operating the business because you were having to make the monthly payment from the bank, which really defeats the whole purpose of running the business in the first place. Now, as you start to grow and you have regular accounts and income and customers that are paying on time and you're getting new customers, well then at that point, and that might be 6 months down the road, it might not be very long at all, but at that point you can then start looking at obtaining a loan, some financing from a bank or an individual. Now, the treasury function, and we've talked about the capital structure, the treasury function, and also the treasury function of the business. What is the treasury function of the business? What might that be? What might the treasury function of the business be? The treasury function of the business is really when and how much debt or equity you take on. The treasury function of the business acts very much like a CFO. Very much like a CFO in the sense that as a CFO, the chief financial officer of the company, you're constantly looking at the cash flows. You're not looking at the profits. Forget the profits, right? You're looking at the cash flows of the business and you're looking into the future and you're saying, wow, we've got some great customers and they want additional product. I don't have the money to fulfill their needs or orders. I wonder if I should take on additional money. I wonder if I should take on an investor. At which point you're going to start having to do a valuation on your company. Or you could go out there and take a loan from a bank, at which point you probably still may be personally liable, meaning the collateral is going to come from your personal assets, unless your business has at least 2 years of operating history and some significant assets. That could be a building. Could be anything along those lines. What is it that you're going to do and when? The timing. The timing. Timing is absolutely critical to your success in not only raising the money, but in how much. It's been my experience that startups need the money yesterday. I just got this new account. They're a huge account. They want 10,000 widgets, and I don't have the ability to produce it. I need to borrow money for 60, maybe 90 days, Aram, and I will fulfill that order. The order will be finished and shipped at the 90-day point, and then I'll get paid in 30 days from that. So we're really looking at 120 days out. So Aram, I need a 4 to maybe, let's just round it off to a 6-month loan. So you have the sales, and it's basically an accounts receivable loan, but you needed the money because they just ordered. You needed the money, and you needed to start ordering that raw material 2 weeks ago. If you can anticipate, and you can't anticipate it all, but if you can start anticipating when you're going to need some of this money, the requirements of this money, then you can start thinking about debt versus equity, the timing of it, and how much it is that you need. Are you going to do a revolver? What's a revolver? When it comes to debt, what's a revolver? Versus, say, a term loan. What's a revolver versus, say, a term loan? Well, a revolver is like a home equity line of credit, a HELOC, in that let's say you get $100,000 in equity out of your house. you don't have to draw down on it all the time. And whatever you draw down on, that's the interest that you're going to be paying. Okay, that's the interest you're going to pay down on. Now, a term loan is, okay, I'm taking this from the bank, $1 million or $100,000, whatever it may be, and now I'm paying interest on it every month. Whether I'm using it or not, I'm paying interest on the full $100,000. That's what they gave me. That's what I'm paying interest on. Well, with the revolver, I'm only using $20,000 for the next 3 weeks. When I get the cash flow, I'm going to pay that $20,000 off. And then I might need to draw down again a week after that for $40,000 or $50,000. But I'm only being charged interest on the amount that I'm utilizing. So whatever you pay down, whatever you're able to pay down, you're just going to end up paying interest on whatever's left. And now if there's nothing left, then that's great. But the flip side of that is, on a revolver, you're going to have a higher interest rate. So because of the flexibility. So you're going to have a higher rate than the term loan. There's also going to be a little more flexibility here with the revolver. Now, banks like to give out more term loans than they do revolvers because then they can predict their future cash flows, right? So revolvers are not as popular, and that's one of the other reasons why they charge higher interest rate. They're not as popular with bankers, but I would recommend looking at, if you're going to do some debt, that you look at a revolver, because you can draw down on it and pay it off as needed. Okay? Now, every time you raise money, it's called a round. Now, the first time you raise money, and this may be from the founders, it's going to be called the seed round. It could also, yeah, we're just going to leave it like this, the seed round. There are several interchangeable terms. But the first time you raise money to start your business, it's called the seed round. The second is going to be round A. The third, round B, etc., etc. And these rounds are going to primarily come from, so seed round is typically going to be founders. Round A and round B are investors. The seed round got you off the ground. The seed round was planted by you so that you could actually acquire some equipment, so maybe you could do some more beta and get this product onto the marketplace. Build out a website, start working on your social media, start taking some inventory, you're getting some COGS, your cost of goods sold, et cetera, maybe hire an employee, whatever that may be. Now, these rounds are also referred to as tranches. Rounds can also be referred to as tranches. So you have the first tranche of funding is your seed round, the second tranche of funding is your round A, your third tranche of funding is your round B, et cetera, et cetera. These terms you need to know because you're going to be raising money for your business at some point. Now, these rounds are often tied to milestones. These rounds are often tied to milestones. You know, if you're going to grow your business, you're going to need money. And as you achieve certain levels of growth, we call those milestones, it's not a bad idea to say, okay, when we reach this level, when we get to this level here, we're going to need to go for round A. And that's going to be tied to a milestone, and that milestone is going to be tied to another milestone. So that way we can say, look, this money is going to get us to round B. It's going to get us to this milestone, which then will get us around. So they constantly are tracking each other. So you say, okay, well, I want to do round A because I want to get to this level. So I need $100,000 so that I can buy enough equipment, hire a couple of individuals that I might be able to generate $1 million in revenue. And so thus you do a tranche or a fundraising round. Maybe it's a round C. But it's tied to a milestone in the future. It's tied to a milestone in the future. And what you have essentially with milestones is you're building what we call fundamentals. You're building the fundamentals of the business. And if you think about Warren Buffett and the way that he invests in the fundamentals of a business. He invests in the people. He invests in the economics of the business and the stability or the sustainability as well as the growth of the business. He's investing in the fundamentals. And as you achieve more and more milestones and you become more and more independent, your fundamentals will grow. And they'll become more attractive. Maybe that means that you'll have no debt. Investing into a company with no debt has its advantages. You don't have to worry about them accidentally tripping one of the covenants in the bylaws of a loan, of a bank loan. And they're debt-free, so if the economy takes a really big hit, they don't have to worry about paying off the equipment because they own the equipment outright. They own the equipment outright. So when you're building the fundamentals, you're really building the economics. You're really building the economics of the business. Now, when you're a startup and you're dreaming, you have to do what we call pro formas. You know what pro formas are, Maxwell? Pro formas are called projections, or just a fancy word for projections. But this is the term pro formas that's used when discussing or negotiating with an investor, which could be an angel fund or a venture capital fund, or a bank. They're going to say, they're going to ask you, do you have any projections? But what they're going to say is pro formas. You have your pro formas, and you're going to say yes. And I recommend that your pro formas be for 36 months. it's difficult to predict what you're going to do in revenue in 3 years, much less 5 years or 8 years. So my recommendation is that you do 36-month pro formas. That's 3 years. 3 years of full projections. You can also call these parametrics. Now, you might not know what's going to go on in 3 months. That's why, again, 36 months is typically my max that I like to see. Your guessing is not enough as it is. Going 5 years out really puts a strain on your credibility. 3 years is completely fine and justifiable. All right, now, you're also going to do 3 scenarios of 36-month pro formas. Do you have any idea what these scenarios are, Maxwell? Best, base, and worst case scenario. So you have the best case scenario of 36-month pro formas. You have the base case and you have the worst case. Why is it that I'm having you do 3 different scenarios? What's the problem with doing one? 98, 99% of the world issues just one set of pro formas, and they're typically 4 or 5 years in length. Some of them are 36 months. But why is it that they only give one set of pro formas? And which set is it? Are they doing the worst case? Are they doing the base case? Or are they doing the best case? What is the scenario that they're actually providing the investors or the bank? That's right. That's right. They typically do the best case scenario because they're trying to sell it. They want that loan. They need that investment in equity. Whatever it may be, a debt or equity scenario, they require money and they require it yesterday. And they always use the word conservative. And I believe we've talked about this. Do not come to an angel investor and say, or go to an angel investor, I should say, and tell them, look, I have done my financials. They're 36-month pro formas, very detailed, and they are conservative. Well, I've got news for you. They're always conservative. Every set of pro formas that I've ever seen, for the most part, they're projections, they're engineered numbers, and yet I hear the word conservative. Oh, we cut them in half. What I want to see, and the chances of you getting funded increase exponentially, is if you do 3 sets of 36-month pro formas. Do a best, base, and worst case scenario. A best, base, and worst case scenario. Because the scenario that I always see is this. This is the scenario I always see. What is this? You know what this is? It's a baseball field. And I'm always seeing the home run or grand slam, which is out here. The base case scenario is going to be a base hit. It might be a double, it might be a single, it might be a triple. And the worst case scenario would be that I want to see is going to be a single. That's the worst case. If the worst case works, you're in business. You can always work towards the home run. You don't need to reflect that your business, because it's in this industry and because you have this amount of experience and because you have this proprietary technology, is going to be a home run. You don't have to represent it that way and then say that it's conservative. That's like me saying, if I was a professional baseball player, well, if you throw me this pitch conservatively, I'm going to hit a home run. Well, how true is that? Even as a professional baseball player, I might not be able to. But if I say to you, okay, throw me this pitch, the worst case scenario is that I get a single. Sure, there's the chance that I could strike out. But given all of the risks and everything that I know that you're going to be throwing at me, and knowing that Robert can only throw a maximum of 50 miles an hour, and I'm Hank Aaron, the chances of me saying, hey, I'm going to hit a single, I mean, that's a pretty likelihood. That's a strong likelihood he's going to hit that single. So don't go for the home run, even if in your heart of hearts you believe it's a home run, because everyone believes that their venture is a home run. Provide the worst case scenario. Provide the worst case scenario, because I'm here to tell you that investors and banks, they will see through your best case scenario because it's all engineered pie in the sky stuff. Now, a bank may not. A bank may not see it as well. So you might go with a base case and best case scenario with the bank. But an astute venture capitalist or angel investor is going to see right through your best case scenario, and they're going to take it apart. And you're going to be left answering questions all day long instead of providing them with the worst case scenario, them asking a few questions, and then you talking about the milestones that you're going to hit, which is why you need the money now anyways. Instead of defending your financials, you're going to be talking about the milestones or the opportunities that you have that you're going to hit in the future. Best base, worst case scenario. Don't forget it. In fact, I may write this down, because when you see best case scenario, when you see best case scenarios, it's almost human nature that people try to pick it apart. So spend your time discussing the opportunity, not defending your best case, conservatively speaking, scenario. You're going to want to make sure, and I've gone through this numerous times. I've been on both ends of this. Don't say the word conservative. Take that out of your team's vernacular. And do not provide just one set of financials. Anybody can do financials. Anyone can do financials. It's not a lot of difficulty. You understand how to do some Excel, bam. You got yourself some engineered pro formas that are all made up. But if you do 3 sets of scenarios, best, base, and worst case, it really lends to the credibility of you. And as an investor, I appreciate the fact that you're watching out for me in the worst case scenario. Here's something else. The companies that I've invested into, more often than not, when I've invested into a home run, it's turned out to be a strikeout. When I've invested into a single or a double or a triple, it has materialized into a home run or a grand slam. Companies like Matrix Initiatives, which was the creator of Zycam. I founded that company out of an empty warehouse. I funded it. I did not found it. I'm sorry. I funded that company. I funded the inventors and the team out of an empty warehouse. Originally, they were making gum. That's their whole business model. That was a good single and a double. The reality of it is they created Zycam. They called me up one day and said, hey, we think we have come up with the closest thing to the cure for the common cold. That was what they came up with. That's what they called me. And I'm sitting there thinking, wow, I invested in them so they could use gum as a delivery system for vitamins, and now they've got a synthetic nasal gel spray, and that turned into a grand slam. I've had other companies that have said, we've got this technology, we've got the patents all around it, and no one can touch us, and we are going to rock the industry. Only to find out that they couldn't execute it, that they couldn't leverage the technology. They didn't have the sales expertise. They didn't understand the market and what it was that was required of them. They didn't have the right team. Only to see it spiral down. I've had it on both sides. I've had it on both sides. And I can tell you again that we appreciate worst case scenario financials more than we do the best case. It's always great to see the home run. That's what's sexy, right? It's sexy to show the home run. It's sexy to show that best case scenario, and that's what gets people hyped up, right? That gets people excited. But a lot of VCs and angel investors aren't impulse buyers. We need to see the risks. We need to understand the risks before we see the opportunity. And in the US, oftentimes we invest into things just because of the opportunity. We don't even see the risks. We don't even see the risks. Now, let's go back to crafting this deal. You're a startup business and you're looking to raise some funds. We need to have a couple of tenets under our belt. Number one, in order for you to craft a deal in terms of you raise money, and this means raising funds. Number one, you need to understand the economics and the nature of your business. I know that seems relatively elementary, but you wouldn't believe how many companies don't understand the economics. By the economics, I mean the costs, the total cost of ownership that goes into your business and the sacrifices that are made in order to make that product at a certain price point. Understand the economics. Understand the nature of the business. What industry is it in? Is it an industry that's declining? Is it an industry that's moving up rapidly? What is it? If you can articulate this, the nature of the business, the industry, and the economics, I'm telling you that the investor will be much, much happier to know that you understand your business better than they do. I can't tell you what a turnoff it is when I walk into a meeting where somebody is looking for funds and I know more about their business than they do, and I'm not even in it. Angel investors and VCs get brought up to speed very quickly. Let me give you an example. Several months ago, I had an individual approach me for funds because they were getting into Groupon's space. And they were talking about the huge opportunity, and they were going to geoscape this thing, or geofence, I should say, these areas. So as soon as you came in, you got alerts on your phone about what deals were going on at what restaurants, et cetera, et cetera. And they were really excited, and they gave me this gigantic pitch, and of course it was on the best case scenario. They were showing me the home run. And I said to them, look, I love your model. And I like the industry you're in. But there's one problem. No one has been able to make money in it. Groupon has not been able to turn cash flow positive. What makes you think that you're going to be cash flow positive before Groupon? They have more resources. They have more people. They haven't been able to show a profit or that they're cash flow positive. So although I like the whole theoretical industry and whatnot, no one has been able to make money at it. Make sure that you know the economics of the industry better than the investor. Understand the investor's needs. And by this, understand their perception and rewards. What is it that they are looking for? What is it that I am motivated by? Again, we just talked about 3 different scenarios: best, base, and worst case scenario. I appreciate the worst case scenario. You need to know that. I'm hoping that it turns into a best case scenario, but what else is it that I value? Is this a short-term play or is this a long-term play? You tell me. You're the one who has to know me. I'm the investor. I'm the financier. What is it that I am providing you in return? What do you need to know about me? What is it that I value? Do I want maybe product as well as a return on my investment? Do I want you to sell this outright? Because if in 3 years, because if you are trying to build this business over a 10-year time frame, and I want you to sell in 3 years, and we're not on the same page, and yet you take my money, you can rest assured in 3 years, I'm going to be knocking on your door asking you, why in the heck is this company still owned by you. Why haven't you sold it? Oh, well, because we're growing and look at what we've done. We've done some amazing things, et cetera, et cetera. I don't want to hear that. You took my money, and I had the impression that you were going to sell this thing in the next 3 to 5 years, and here we are at the 3-year, 36-month point. And I know we're doing great, but we're not doing that terribly well, and I want my money back. Plus the return that you think that we might be able to get from selling this thing. Understand my needs. I might be in it for the long haul. And you may come at me at 3 years and say, hey, look, somebody wants to buy this thing. Okay. Either way, understand the perceptions and the rewards that the investor or financier is looking for. Understand your own needs and requirements. Understand what it is that you need to get out of this in order for you to put your heart and soul into it. In order for you to grow this business, what is it that you need out of it? Is it okay for you to have 75% or maybe even 35% of this business after 5 or 10 years? That might be okay. Is it okay that you are just a minority percentage owner, maybe 10% after 5 or 10 years? Maybe that's not acceptable. Maybe you need to be 100% owner. Maybe you need to be growing this thing. In return, you're going to take all of the cash flow. You're putting your blood, sweat, and tears, your sweat equity into this thing, and you won't take anything less than 98% or 100%, whatever it may be. What are your own needs? Well, if you're taking on an investor, it's going to have to be something south of 100%, right? But you can still grow the business if you take on some debt and you still be 100% owner of the business. What are your needs? What are your needs? We talked about the treasury function of a business when it comes to funding. Number one, you need to know the absolute amount of funds required. This is your minimum. The minimum. What is the least amount of money you can use in order to grow your business? So I often see companies, and this is I think prudent. Companies do what's called the mini max. Look, in order for me to get to the next milestone, the next level, Maxwell or Darren, in order for me to get there, I need your money. But the minimum amount in order for me to get there is going to be $1 million. Now, anything above and beyond that, we're going to be able to grow exponentially and even faster. So the maximum amount I'm going to take is going to be $2.5 million. But $1 million gets me there. 2.5 gets me there a lot faster. So I need to know the absolute amount of funds required, but I need to know the minimum. And then we talked about it before, we need to understand the timing. We need to understand the timing. Again, just like I mentioned earlier, I see it all too often that they needed the money 2 months ago and they just started working on funding today. Ridiculous. You need to know the treasury function of the business, because as a startup, you're going to be chasing dollars all the time. You're going to be spending about 80% of your time on sales, and you're going to be spending a portion of your time sourcing raw material, and then you're going to be spending the rest of the time trying to raise funds. Let's look at this visually here in an illustration. We understand that growth is what kind of a function? Darren, what kind of a function is growth? Or Maxwell, what kind of a function is growth? Growth is what kind of a function? That's right, it's a step function. And here we have, and I've shown this to you before, this is our break-even graph. And this x-axis is time. This is 1 year, 2 year, 3 year, 4 year. Down here, this is your dream stage. It's below the actual point of when you start your business, which is right there. And here you're going to come in with a seed round. This seed round gets you to maybe here. Let's just say that's 8 months. And you got to get to year 2. Because that's when you're going to, right around that time is when you're going to become cash flow positive. This area is also called what? That's right, Darren, you're going to go through the 4 F's to just seed round. Friends, family, fools, and founders. This area right here is Death Valley. Because if you don't make it out of this, your business is done. And this right here is your expenses. And the black line is going to be your revenue. And this right here is your break even, where expenses and revenues actually meet and you're paying for your own business. But before you get there, you might need another tranche of funding. So here, you are, you've gotten to this level, but now you need to get to here. So this might be round A. To get you to round B, you're going to need to get funded here, and you're going to have to show your worst case scenario from here to here, so you can get to a round B. Do you see how your milestones are tied to your growth? Kickstarter is an A round. Good question. That's your seed round. That's your seed round of funding. And it's theoretical that you could have 2 or 3 seed rounds where you have a Kickstarter, and then the founders also kick in some money, and then you have also maybe some friends, family, and fool that kicks in some money. And then you continue to grow, but now look, now you, from here on, from break even on, you don't necessarily need money anymore from a bank or an investor. Is that correct? It is and it isn't. What were you typing, Darren? It is or it isn't? It is and it isn't correct, I should say. You always need capital to grow the business. But the beauty about this point right here is if you don't get the money, you can continue to grow organically. This here, we're denoting this as cash flow. But you may need additional funding here and here and here to accelerate and continue growing the business. The two words that I do not like, number one, we know is profitable. I prefer cash flow, right? I don't like profitable, I like cash flow. The other word that I don't like is sustainable. Sustainable to me means maintain. And I know it's a big buzzword in industry. That's right, cash is king. I want growth. I do not like sustainable. I do not like the word maintain or sustain. It denotes a leveling off. I want to see growth. So that means that when I put money in here, round A, I want to see you getting money up here. I want to see you getting money after you break even because I want to see the business accelerate, expand, and extend their presence into new markets, into new customers, and grow my investment. That's the name of the game. That's the name of the game. So you may have done round A, round B. Here's round C, D, etc. You're always going to be looking for funds. As a startup, I'm telling you, you are always going to be looking for funds. Those funds may be for additional employees, cost of goods sold, whatever it may be. You may be even looking to acquire another business, a competitor, which would be a horizontal acquisition. You may be looking at buying somebody that is supplying widgets to you so that you can build out your final good. That would be a vertical acquisition. Either way, you need to know that you're going to do several tranches of funding as you grow your business, even beyond your break-even point. Even beyond your break-even point. Any questions or comments? Any questions or comments? This is, I cannot stress this enough. You need to understand the process of growth and how fundraising plays into that. Now, if we circle back, we loop back to the very beginning of this class today, we can then say, okay, on round B and C, we don't have to worry about dilution because we have those shares in treasury stock that's already been authorized, so we can use that in order to get money from investors. We don't have to amend our articles of incorporation to add more shares and thus dilute everybody, and that's going to take another day and 45 bucks or whatever it is. Forget it. You see how this all weaves together nicely? When you have questions, when you have comments, after this class is over, I'm not just talking about today, I'm talking about after the semester, you email me. That's what I'm here for. You email me. You make sure that if you don't fully understand this graph and you don't understand crafting a deal and how it works, then you need to talk to me. End of class. See you tomorrow. See you on Thursday, same time, same channel, 1 p.m. See you soon.